Welcome to This Explainer. Today, we're taking a dense 42-page SEC 10Q filing, the kind of document that usually cures insomnia, and we're going to translate it into a crystal clear picture of a major commercial real estate player. If you've ever stared at a wall of financial disclosures and just felt completely overwhelmed by the sheer volume of data, well, you're in the right place. Today, we're zeroing in on Piedmont Realty Trust's second quarter results for 2026, and we're going to see exactly how they are navigating today's incredibly complex commercial property market. So let's just get right to the elephant in the room and ask the big question on literally every investor's mind when it comes to the post-2020 real estate landscape. How is the traditional office actually surviving in 2026? I mean, it's super easy to read doom and gloom headlines about the death of the office, right? But when you actually dig into the financial data, it tells a much more nuanced and, frankly, a really fascinating story.
To get to the bottom of that, we're going to perform a thorough corporate health check on Piedmont. We'll quickly cover who they are, the modern risks they're dealing with, their actual Q2 financial performance, and finally, how they're managing all that debt.
All right, part one, who is Piedmont? Simply put, they're a massive landlord focused on premium, top-tier Class A office spaces across the booming U.S. Sunbelt markets.
Now, you really have to wrap your head around the sheer, massive scale of their footprint. We're talking 15.1 million square feet spread across 29 in-service projects as of June 30th, 2026. This isn't just, a handful of office buildings. It is a sprawling ecosystem of corporate infrastructure. And when you operate at this massive of a scale, your financial health essentially becomes a bellwether for broader corporate leasing trends down in the Sunbelt.
And here is where it gets really interesting. Despite all those cultural narratives about empty offices and the work-from-home revolution, their portfolio remains robustly leased at 88.9%. That's a huge deal. It really illustrates that while the way we work might absolutely be changing, the actual demand for premium office space in strategic markets, it's highly resilient. I mean, almost 89% of that 15.1 million square feet actually has a paying tenant attached to it. Moving on to part two, the modern office risks. Because running a multi-billion-dollar portfolio isn't just about collecting rent checks, it's about anticipating what could totally disrupt your business tomorrow.
If we group their dense, forward-looking legal disclosures into some key themes, we can see exactly what keeps management up at night. The company specifically calls out things like artificial intelligence and machine learning, right alongside virtual meeting platforms, as massive tech shifts that could alter how commercial space is used. But it's not just tech. They also highlight inflation, possible recessions, and even geopolitical developments that could scramble their supply chains.
And notice how explicitly these modern threats are spelled out to the investors in the actual filing. They are legally forced to meticulously detail these factors, everything from cybersecurity incidents down to the financial condition of their largest tenants. It just goes to show you that physical real estate is now deeply, deeply tied to digital and macroeconomic vulnerabilities.
Okay, part three, Q2 financial performance. Let's look past the risks and the square footage and check the vital signs. The cold, hard cash actually flowing through the business. Now, before we look at the raw revenue, we've got to understand a key metric they use for their projections. It's called annualized lease revenue, or ALR. It's actually pretty simple. You just take the current monthly base rent, add in the operating expense reimbursements, and multiply the whole thing by 12. It gives everyone a nice, stabilized view of the cash flow from executed leases, completely ignoring messy things like temporary rent abatements or buildings currently under construction. So, checking that revenue heartbeat with their recorded numbers, we're seeing a really healthy, tangible increase in rental cash flows year over year. Back in Q2 of 2025, that rental and reimbursement revenue was sitting at $133.9 million. Fast forward to Q2 of 2026, and it bumped up to $137.2 million. That is a solid multi-million-dollar jump. It tells us for sure that their pricing power and their lease renewals are holding remarkably strong.
At the exact same time, we're seeing their net loss shrinking pretty significantly, which is a fantastic sign of stabilization. They went from a $16.8 million net loss in the second quarter of 2025 down to an $11.1 million loss in Q2 of 2026. Chopping a loss down by over $5 million in just a single quarter, that is exactly what you want to see when the broader economic environment is tightening up.
But hold on a second. Why is there a net loss at all if revenues are up to over $137 million? Well, this perfectly highlights the quirky nuance of real estate accounting. Massive non-cash depreciation is heavily dragging down their net income. In Q2 alone, Piedmont recorded $44.8 million in depreciation expense.
Basically, because buildings physically age, accounting rules force companies to deduct that wear and tear from their profits, even though literally no actual cash left the company's bank account for it this quarter. If you look directly at their consolidated income statement, right there under property operating costs, you'll see that $44.8 million depreciation line item doing all the heavy lifting to pull their net income into the red. And honestly, this is exactly why seasoned analysts will always look past the bottom line net loss figure to figure out a real estate trust's true cash-generating power.
Which brings us to part 4, managing the debt. Real estate is intensely capital heavy, and how a company structures its borrowed money acts as its armor. It totally dictates whether they thrive or fail during turbulent times.
They made a major, incredibly strategic move this quarter by upsizing a previous loan. They essentially took a $325 million loan, expanded it into a $400 million unsecured term loan, at the same time pushed its maturity date all the way out to May 2031. This is just a classic smart defensive maneuver. By extending that maturity, they are buying highly valuable time, totally avoiding the immediate panic of having to refinance a massive chunk of debt in a potentially brutal interest rate environment.
And to protect that newly upsized loan, they deployed a crucial financial tool, interest rate swaps. They essentially traded their unpredictable variable rate for a fixed 4.94% rate that lasts through June 2028. It's basically like buying an insurance policy against spiking interest rates, and it adds some much-needed predictability to what they'll have to pay in future interest expenses.
Looking at their overall debt roster, you can clearly see this strategic blend of fixed and variable rates. They've got a $197 million secured mortgage locked in at 4.10%, the newly minted $400 million term loan, and some older senior notes sitting at a much higher 9.25%. But by blending these high and low rates together, they managed to hit a very reasonable weighted average of 5.62% across all their unsecured debt. This deliberate mixing is exactly how giant portfolios survive their capital costs.
So why do we care so much about this debt table? Because keeping an eagle eye on these specific maturity dates is absolutely vital to understanding their refinancing risks. If you check the timing on these massive loans, you see exactly when the bills come due: 2028, 2029, 2031. As an investor, you're terrified of a maturity wall where billions come due on the exact same day. But Piedmont, they've staggered these dates beautifully to make sure they can handle refinancing piece by manageable piece. And the really good news? As of the end of Q2, management confirms they are fully in compliance with all of their financial covenants. Plus, remember those interest rate swaps we just talked about? Because of how global rates have fluctuated, Piedmont swaps are actually sitting in a net asset position of roughly $530,000 on their balance sheet. So yeah, their financial armor is definitely holding strong.
So we've checked their vitals today, and honestly, from shrinking net losses to incredibly smart debt management, things look remarkably healthy. But as AI and virtual reality continue to rapidly disrupt the traditional workplace, how is this 15.1 million square foot Sunbelt empire going to adapt for the future? Is premium Class A space going to remain the ultimate corporate necessity, or is the physical footprint going to completely evolve by 2030? Well, that is the multi-billion-dollar question. Thanks so much for joining this explainer, and remember, always keep questioning the data.